Hey Bowtie Nation, Joseph Hogue with your weekly stock market update, now on Sundays at noon before the market starts, with the stocks to watch and the stock market news you need to see. And Nation, three AI trends are colliding right now, and they're going to decide where your money and your life goes next. First, AI is getting smarter, faster than anyone predicted, and we're trusting it more than we should. Second, it's creating a hacker nightmare where nothing online feels safe. And third, demand for data centers is exploding, causing outages and price increases. And while Wall Street gets distracted by headlines, I'm going to reveal 10 stocks you need to be buying ahead of all of this. Stick around and I'll highlight 4 stocks I'm watching this week, plus the only thing you need to understand about this market to know where stocks are heading. First, on to AI though, because 3 trends are coming together that will change not just the stocks involved, but also your life, and you need to be ready. Now, I know the news is at no loss for apocalyptic AI predictions, but there are 3 trends that you need to be watching. First, here is the fact that AI is getting smarter way faster than we thought, and that's creating problems. Not the Terminator problems everyone predicted, but problems in trust. It used to be the worst image on AI was the random 6th finger on an image. Now, besides the hallucinations, AI agents are also going rogue. The Wall Street Journal reports one case where an AI assistant designed to read emails and act as a personal assistant started making up emails, telling the user that his family was emailing him to buy Klondike bars and Fireball whiskey for a family reunion. Now, I think it's a great idea, especially the Fireball whiskey, but the emails were totally made up. The problem here is as AI gets better and does more things right, we're starting to trust it more and then not question those frequent mistakes. In another example, an AI safety researcher at Meta set up an OpenClaw AI agent to help manage her emails, and then the AI went rogue and just started deleting everything and wouldn't even stop when she told it to. Besides just in our daily lives, this has big implications for software stocks, all plunging on those fears that AI is going to do what these companies can do. The iShares Tech Software ETF, the IGV, is down 23% over the last 6 months, with individual names down even further. Snowflake, ticker SNOW, is down 39%. ServiceNow, ticker NOW, is down 45% over the period. But clearly, Nation, companies are not going to be rushing to replace their software vendors with AI agents that haven't been tested and that can go rogue without notice. Maybe in the future, a few years down the road, but revenue growth is still topping 20% plus for many of these companies, and it's only a matter of time before investors realize they've been sold off too early. The second trend here, and this is the scary one, is what some are calling bugmageddon and warning of a bigger risk than even Y2K. The big news was Anthropic's new model Mythos last week, an AI model so powerful at finding bugs and backdoors into software that the company decided not to release it. Now think about that for a second. A product that is so powerful that a for-profit company is not releasing it because of how dangerous it could become. Instead, Anthropic is working with the government, banking executives, and cybersecurity companies to prevent hackers using this as a tool to get into, well, pretty much anything. Now, to understand how bad this could get, understand that most software on which everything on a computer or online runs is kind of like a cake. That main code on which the software runs is just the top layer. Under that can be decades of open source software, patches, and other code that have been added up layer after layer onto that cake. Now, case in point, a 1998 bug in the OpenBSD operating system was one of the thousands found by Mythos just last month, 28 years since the code was written, and it was still being used within some of those layers of software across businesses. Now, an earlier model of Anthropic just last month discovered more than 100 bugs in the Firefox browser and was able to write code that could exploit one of them to gain entry. One more stat here defines how bad this nightmare could get. 8 years ago, the average time between public disclosure that a bug existed in a piece of software's code, it generally took about 847 days for hackers to exploit that in an attack. Last year, that dropped to just 23 days, and this year, most reported bugs have been exploited within a day. Now, even though Anthropic is taking the high road and working so that Mythos doesn't become a tool for hackers, AI is already being used to drastically increase the attack surface. Hackers are not only using AI to find bugs in software, but to generate an almost infinite number of scams to phish passwords and other personal information. The question here is, what will be safe when hackers can get into pretty much anything? A nation, I'm not trying to be chicken little or an alarmist, but the threat is there and means investors should own some real physical assets to protect their wealth. Now, this means investments in real estate, productive land like farmland, and stocks in essential businesses like utilities and energy pipelines. It also means that sell off in cybersecurity stocks is way overdone. The NASDAQ Cybersecurity ETF, the CIBR, is down 11% over the last 6 months as investors worry that AI will also be able to replace what those cybersecurity companies do. But in fact, we're seeing it do just the opposite. While AI can help enforce network security by finding those bugs and writing codes, it's also dramatically increasing the attack surface for hackers. Much like with the software story, companies just aren't going to be in a rush to replace their cybersecurity vendors with an AI agent that could go rogue without notice. And that means IT budgets for cybersecurity and revenue to these providers is going to keep growing to keep those hackers out. I own and am adding to positions in Zscaler, ticker ZS, CrowdStrike Holdings, CRWD, Palo Alto Networks, PANW, and Fortinet, ticker FTNT. The trigger here in these stocks is going to be the quarterly earnings reports like we're coming into right now. Investors have sold off these software and the cybersecurity stocks like that future revenue and the earnings is going to get destroyed by AI, but that just is not going to happen. Yes, eventually the AI may eat into the growth for some of these, but it's not happening this year or next. When these companies report earnings and give their updated outlooks for the year and even the year ahead, when investors see that 20% plus revenue growth is still expected and the AI apocalypse scenario isn't happening anytime soon, these stocks are going to bounce higher faster. The third trend is in the new super shortage bottleneck in AI. First, it was in networking equipment, which is why I recommended Arista Networks, ticker ANET, Astera Labs, ALAB, and Broadcom, AVGO, more than a year ago. Now all three up from 124 to 190%. Then it was power generation, so I recommended Bloom Energy, ticker BE, last June, now up over 1,000% in that time. Now the shortage is in that whole shebang, the compute capacity to run those AI models. Token use on OpenAI's platform increased from 6 billion a minute in October to 15 billion in March, 150% in just 5 months. The cost to rent NVIDIA GPU chips at a data center have jumped 48% just in the last 2 months, and demand has gotten so bad that Anthropic is suffering so many outages, users are starting to switch models. Folks, this just proves we are still in the building phase of that AI revolution. That's 700 billion plus in AI spending just from the 4 hyperscalers, Meta, Alphabet, Amazon, and Microsoft, and then the trillions that are going to be spent over the next few years is just getting started. And that means it is still the infrastructure stocks you want to be in, following that semiconductor supply chain like we've been doing over the last 2 years, and then buying the companies critical to this building out phase. That's names like NVIDIA, ticker NVDA, Advanced Micro Devices, AMD, Broadcom, AVGO, Marvell Technologies, MRVL, Taiwan Semiconductor, ticker TSM, and yes, even Super Microcomputer, ticker SMCI, which is now up 38% from its March crash and approaching that $30 a share once again. Now, before turning to the stocks I'm watching this week and our market outlook, I'd think about something Austin Goolsbee, president of the Chicago Fed Bank, has said recently.
I still think the impact on employment in the short run is very much determined by how fast is the adoption. And I don't think the AI adoption rate has been as fast as maybe its biggest proponents say. So the immediate impact on the job market might not be as big as what folks think. And I think if AI has the improvement to productivity that everyone's describing, it's going to make us rich. There are going to be a whole bunch of things that it creates, opportunities that it creates. So if you think that if we come back in 10 years, that the steady state unemployment rate is going to be 15% or something, I'll take the under on that.
It is going to make us rich. Nation, AI is here and it's not slowing down. Whether it takes jobs or not, you need to be benefiting from it by investing. First in those AI stocks that are the first winners, like NVIDIA, up 11 times your money in just over the last 5 years. Or Bloom Energy, now at more than 10 times your money since recommending it last year. Then, as AI does spark that productivity boom, investing across the broader market to benefit, because yes, this is going to make us rich if we're investing in it. I'm going to highlight the stocks I'm watching this week next. 4 stocks with a surprise upside heading into earnings this week, but if you haven't already, join me on the Blossom Investing app and see all the stocks I'm buying in real time. It's totally free to download, helps support this channel, so I appreciate that. And you're going to see what over 500,000 investors are talking about in the social feed. So look for the special invite link in the description or just scan the QR code here. Looking at the stocks I'm watching this week, RTX Corporation, ticker RTX, reports earnings on Tuesday, with the stock already up 50% over the last year as the old Raytheon benefits with the rest of defense stocks on the Iran war. And there could still be room for upside here, though, as an upgrade to expectations. Right now, analysts see the company growing sales by 5.5% this year and just under 7% next, with a 9% annualized run in its earnings to $7.53 per share. Besides Trump's request for a giant increase to a $1.5 trillion defense budget, RTX is at the center of one of the biggest munition needs. The company's missile interceptor technology is the best in the industry, and a stockpile of missile defense munitions has been drawn down dangerously low over the past 6 weeks, not just in the US, but also across the region. Our shares aren't cheap here after that 50% run, but I expect management to upgrade its own revenue forecast, which could support the investor sentiment. International Business Machines, ticker IBM, may be the better value here, with the shares up just 5% over the past year, following a stellar 2025. The company is expected to report 7% revenue growth when it releases numbers Wednesday, and again here, I would not be surprised to hear an upgrade to analyst expectations for just 5% sales growth this year and next. Not only does IBM benefit from that broader AI infrastructure supercycle right now, but is leading in quantum research, which could be the next wave in tech. Your shares trade for a price of about 20 times this year's forecasted earnings, putting it well below where it's traded at over the past year. In fact, a 60% discount to that valuation just last June. The AI software fears have hit the stock, but it could be setting up for a strong upside surprise. ServiceNow, ticker NOW, reports earnings on Wednesday, with the shares slammed by those fears that AI will replace those software makers, driving the stock down 40% in the last year. Those fears stand in contrast to the forecast for a strong 20% sales growth this year and next, and for the earnings to reach $5 a share next year. The sell-off has taken the shares down to bargain basement valuations compared to its own history, trading at a market cap of just 6 times this year's forecasted sales and a price of 22 times earnings. Now, lingering fears for an AI replacement aren't going away completely, but companies aren't rushing to let those AI agents take over, and ServiceNow is going to continue to book that growth. That means it's only a matter of time before the market realizes how cheap this stock is. Digital Realty Trust, ticker DLR, reports its earnings on Thursday, with the stock up 33% in the last year and at the center of one of the biggest potential surprise trends I'm following. Now, we know that compute power is a huge bottleneck in AI right now. They just can't put up those data centers fast enough, but we're also seeing communities come out vocally against a data center in their backyard, with $64 billion in centers blocked across the US alone. So my question here is, folks, what happens when that computing power is so scarce and new capacity isn't being built? Those existing data centers owned by Digital Realty could see valuation and lease values skyrocket. DLR already owns 3 gigawatts of capacity, with another 5 gigawatts in development across the globe. Their shares aren't cheap after that 30% run, but this is a growth story that's going to play out over years, and take this one higher while you collect that 2.5% dividend. Now updating our stock market outlook, and the one thing you need to understand about this market. Folks, with gas prices still up, inflation showing no signs of slowing, and the war threatening to continue, investors are wondering how this market can break new highs and why I'm so bullish on the rest of the year. And we're not going to get much from economic data this week to support that view. Retail sales and PMI numbers are the only real data coming out, and those are likely to show an economy struggling about flatline. Investors also aren't expecting any help from the Fed either, with expectations for no more rate cuts until September 2027. That's according to the CME Fed Watch tool, which uses futures interest rates to show market expectations. But fortunately, there's only one thing you need to understand about this market to know the direction stocks are heading. That's earnings growth. Earnings are the core driver of stock returns. They're what you own as an investor and what determines stock prices long term. A higher earnings mean another investor is going to be willing to pay more for that stock than you paid for it. And as we head into the first quarter earnings season right now, those corporate profits are set to look very, very good. Right now, analysts expect earnings growth at companies in the S&P 500 index to be about 13.2% higher than where they were last year. That alone is solid growth and would mark the 6th straight quarter of double-digit growth. But as they say on TV, there's more. Actual earnings growth is likely to be much better than that. Nation, it doesn't take long working as an analyst to realize earnings season is the biggest scam in the industry. Analysts try to forecast sales and profits for companies they cover, but at the same time, management is trying to manipulate those expectations, provide just enough information to give Wall Street a good idea so there aren't any big surprises, but also managing those forecasts so they're low enough that the company can beat them when earnings are reported. That makes it look like management is working harder, doing more, that it's so shit hot that it can beat what analysts had forecast on sales and profits, all to justify those $1 million salaries. Hey, maybe that's my years as an analyst and seeing this game play out that's made me cynical, but looking at a chart of earnings estimates and then actual profits reported proves this point. In the last 15 quarters, companies in the S&P 500 have beaten expectations in all but 2 quarters, the third and the fourth quarter of 2022, when the Fed was deep in its rate hike cycle. In fact, over the last 19 quarters, almost 5 years, companies have surprised to the upside by an average 7% and as much as 16% in 2021. I'll put this all together, and if companies beat earnings forecasts by that average 7%, it wouldn't mean 13% profit growth, but over 20% for the first quarter of this year. But wait, there's more. Analysts surveyed by FactSet are expecting further earnings growth of 20% for the remaining 3 quarters of 2026 as well, driven by very strong revenue growth of 9% and higher. Nation, from last year's tax cuts to the tech spending boom and an AI productivity boost that is just getting started, 2026 is shaping up to be a profit bonanza for U.S. companies, and it means one thing: stocks are right now on sale. If we take analyst estimates applied to last year's total earnings of $271 for companies in the S&P 500 index, so what companies reported last year, then earnings growth of about 19% on top of that, we get a forecast of $322 in total earnings this year. Remember, that's just forecasted. If companies beat even those expectations, this could all go much higher. Then here, if we take the S&P 500 at its new high above 7,000, that price of all the stocks in the index, divide that by this year's forecasted earnings, that's that price to earnings, that PE ratio of valuation, that's just 21.8 times. That would not only be a 25% discount from the recent peak valuation last October, around 29 times the earnings, but it would also be well under where the ratio has traded over the last 5 and 10 years on average. Now, this is a trailing ratio, and we're using this year's expected earnings, but the message is the same here, folks. If profits are anywhere close to what's expected, stocks are very cheap right now. A bounce back to even an index price of 26 times those earnings, so that PE ratio of 26 times for the index would be 83.72 on the S&P 500. That is a 19% return from here just for this year. See all the stocks I'm buying in real time with the Blossom social app, free with the special invite link in the description below. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.